Welcome back. This is Open Exchange. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, we were getting our calls coming in from our technical experts, and Mitesh is back with us. Mitesh, tell us, how would you approach trade today? The Nifty Bank has been an underperformer. Does the Nifty have enough to see a bit of a bounce?
Good morning, Nigel. I think there could be bounces, purely because, as Sudarshan also mentioned, this is a market which is contracting and range bound. For me, I think the key event would be either a breakout above 18,150 or a breakdown below 17,820, with the idea that there is a slightly, more chance of a breakdown eventually happening. It may not happen immediately, but I think there is a chance of breaking below 17,820. So with that, I think, we are trading with more of stock-specific biases, but on pullbacks closer to about 18,100 would explore shorting the indexes.
Okay, well, Sudarshan, what would the individual stock ideas be? Let's get straight to that. What are you looking to buy or sell this morning?
See, the markets itself are choppy. The ideas also become a little less relevant because it becomes uncertain. But for whatever, Axis Bank is a buying opportunity. It's been an outperformer. Although I have said that we should stay away from the bank Nifty, Axis could individually do something better. So consider buying that with a stop under 942. Adani Ports is an intraday short. Always short stocks only intraday. Never carry them forward. It's a stop with a stop above 821. Indus Towers is another intraday short. If you see the chart of Indus Towers, you will see it's been falling consistently day after day. Stop above 187. And JSW Steel is an outperformer. That's a buying opportunity. But buying should not be considered for a day. You have to take positional trades either in Axis or in JSW to really get something out of it. But keep a stop at 375 and 735 if you are an intraday trader.
Got that. Mitesh, what about you?
So I have a mix of buys and sells. Eicher Motors gave a breakdown yesterday. That's a sell call. Keep a stop just above 3,200 and a target of around 3,100, which is close to the 200 average area, is what I suggest. Colgate-Palmolive is clearly going through a strong downtrend and could see further declines. The next target areas are around 1465. So that being the target, short positions can be taken with a stop at 1515. And yesterday we saw some good breakout happening on the charts of Motherson Sumi system. So that's a buy. Keep a stop at 77 and look for targets of 84. And some reversal on the chart of SRF. Disclaimer, we have some positions on the long side over here. So SRF is a buy for a trading bounce back to about levels of 23.25 and would recommend a stop just below 22.50 here.
All right, thanks for that. Well, let's go straight to the F&O expert now. Rajesh Palvia, the Vice President, Technical and Derivative Research at Axis Securities, is with us. Rajesh, good morning. What are your thoughts after yesterday's downfall? Do you expect that the market has weakened now? And what are the stocks to watch?
Good morning, Sonia. Yeah, the previous trading session was very rough, and again, Nifty is revisiting to its 100-day moving average support area. In last 15 days, we are seeing that it's a fourth attempt now. Nifty is again trading near to 100-day moving average. So looking at the derivative data perspective, also in the previous session, we have seen significant call writing at 18,000 strike. Even the put writers have covered their position for 18,000, even 17,800 strike, which clearly indicates that base is shifting now lower. So major addition on the put front is visible at around 17,700. So put base is now shifting from 18,000 to 17,700. So it clearly gives us some indication that market may remain under pressure. So just to play this down move of market, we are here initiating a put spread strategy. In this strategy, we'll buy 17,900 put, which was closed at around 66 rupees. On the other end, we will sell 17,800 put, which was closed at around 32 rupees. So your cost for this strategy would be around 34 rupees. And you will remain in profit if it's trades below 17,866 to 17,768 zone. And we are expecting that, if any pullback comes towards 18,000 level, again, market will meet to the supply pressure because a lot of call writing activity is happening around those level. And we feel that, some more pressure we are going to witness in today's session. On the stock front, we expect some buying action we can see in FMCG space. From that space, Hindustan Unilever is looking attractive. In previous session, some short covering action was there in the stock. And looking at the technical setup also, stock is now trading about 20-day moving average. So looking at the setup, we recommend here to buy in the Unilever. On the upside, we are expecting target of 2700. One can keep a stop loss of 2620. Another space which we like, that is pharma. Some buying interest was there in pharma space in previous session, and Zydus Life has clearly given a breakout on the weekly setup. Short covering was there. Looking at the overall setup for Zydus Life, we believe one can buy this stock for upside target of 475, 480. Keep a stop loss of 446.
Okay, well, thanks a lot for that. We'll, you have a great day. We'll come back to you for more later. In the meantime, let's talk about the insurance sector. The insurance premium data for December has come out. Not just that, Axis Bank has revised its deal with Max Financial. The right to acquire 7% additional stake in Max Life will be at a fair market value. To discuss this as well as the December data, we're joined by Nitin Agarwal, the head of banking, insurance and financial research at Motilal Oswal. Nitin, good morning and thanks for joining in. Before I talk about the Axis Max deal, I wanted your thoughts on the data that came out for December. It looked like a weak month, especially for names like ICICI Pru and Max Financial. What's your view on that now?
Yeah, hi, good morning, Sonia. Yeah, really, the numbers for the month of December have been on the softer side only. I think that's a trend which has been going on for most of this year. And ICICI Pru Life and Max have reported relatively much weaker numbers, both reporting like a decline in individual APE for the month. But for the industry, the numbers were around 16% growth on individual APE. And this was led completely by SBI Life and somewhat by HDFC Life, which did relatively better versus the others.
Okay, all right. Hi, Nitin. Nitin, yesterday the market was a little bit wobbly, but we did see Max Financial move higher because now that deal is going to go ahead. They're going to be getting some more money for that 7% stake that Axis will be acquiring. My question to you is, this is good news, but how much of it is in the price? Because valuation-wise, well, the stock is not cheap any longer. Your take.
Yeah. See, this deal is very critical for Max Life because Axis is one of the largest distribution partners and it has driven the numbers all these years for Max. And being the largest banker partner that it has, so once the issue came up, it really put a question mark on as to how the numbers can unfold in the coming years. But with this, I think clarification that came yesterday, and wherein IRD has now advised that Axis can complete the deal of remaining 7% stake buying at a fair value. So that basically takes away that overhang that the stock was in, and we have seen the stock recovering in the recent weeks. Even yesterday, it was up like another 4-5% odd. And I think relatively, because the stock still trades cheaper in the sector, when you compare it to stocks like HDFC Life or SBI Life, Max is still relatively lower in terms of valuation in the pecking order. So as now the fundamental performance improves, you see growth returning back, because even this month was relatively weaker from Max. I think the stock can see some more relief in the coming weeks or coming quarters.
Nitin, hi, morning. So within that space, what do you like best? What do you like least?
Yeah. So our preference has been more towards SBI Life, wherein we believe the growth ratios are much better, and even on a 3-year CAGR basis, which is now more like logical to look at, given that prior couple of years were affected by COVID. And SBI Life over 3-year CAGR run rates also is doing relatively much better. And I think on the back of recent sharp recovery in margins, SBI Life is now on track to deliver industry-leading ROEVs. Like our published numbers, we are already looking at ROEVs reaching towards 22%, because it has now plugged the margin gap versus peers, and the growth rates are running amongst the best in the industry. So which is where we believe the valuations still leave a decent upside to play out.
Got that. So you're saying that there's more valuation upside for SBI Life. What's happening with HDFC Life? It's been a long stretch of underperformance that HDFC Life has seen vis-a-vis its peers. And I mean, even if you look at the last 1 year, right? I mean, a year back, it was at almost 700. Now it's sub 600. Do you see any scope of recovery here?
So, HDFC Life, post the merger between the HDFC Bank and HDFC Limited, which is ongoing, there has been some overhang that has come in on the stock. And separate to that, the numbers also for the most of the year were not as strong for the industry. Though HDFC Life relatively did much better, But because the protection growth has not been as much coming through, we have seen margins like other peers overtaking HDFC Life, wherein earlier HDFC Life used to be the industry leader in terms of margins. So that, to my mind, has affected the stock price performance. But I think as now clarity comes in the coming quarters, numbers already getting better, you may see some performance showing up for the company. We have currently a neutral rating on HDFC Life, which is there now for almost like 3.5 years.
Okay, pleasure speaking with you. Thanks, Nitin, for joining us and giving us a quick take on the insurance sector. By the way, the pre-opening rates have adjusted absolutely flat. So let's get straight to talking about individual stocks then. Our Momentumizer segment is here. Mangalam has more on that. Mangalam, what's on your list today?
Well, I have a stock called BCL Industries, not a stock that we speak about very often, but remember, over the last couple of days when the markets were a little volatile, we have this stock in just the last 2 trading sessions having gained 31%. Yesterday was up 9% as well. Why is that? Well, the company informed the exchanges that on Jan 12th, which is tomorrow, they will consider fundraising via issue of equity shares. It could be a QIP, preferential allotment, or some convertible instruments as well. They have a debt of close to around 380 odd crores and a market cap of close to 975 odd crores. So it'll be interesting to see what they do with the funds that they raise and what's the quantum of the funds that they raise. It is an agri-based edible oil player, processing capacity of almost 1,000 metric tons per day. First half, their revenues were close to around 833 crores with margins of around 4.8%. Majority of their revenues comes in from edible oil and vanaspati fat, 26% from distillery and 1% from real estate as well. In terms of technicals, the stock is above all its daily moving averages, important ones, 20, 50, 100 and 200. And yesterday, the shares marked for delivery were startlingly high. Yesterday, it was close to around 1.93 lakh shares. Jan 9th, the previous trading session was just 1.43 lakhs. And the 3-month average has been about 50,000 odd. So maybe at higher levels, at higher prices, a lot of shares being marked for delivery. All eyes on the outcome of the board meeting tomorrow.
All right, Mangalam, thanks very much for that. By the way, yesterday on D Street Chatter, Nimesh had highlighted BCL as it was one of the stocks, and what he'd said was that an influential HNI investor is likely to pick up stake via a pref issue. So a lot of the, perhaps news flow and price action and some of the data points that Mangalam talked about tying in. So keep an eye out on that one. It's done very well recently, as Mangalam pointed out. Now, the 9-10 calls, we are racing into market open. Just 5 minutes to go. Sudarshan, what would your call be?
The Nifty is an avoid. It is a trade only if it breaks out above the resistance and support levels I have discussed earlier. JSW Steel is a buy with a stop under 735.
Mitesh, what about you?
Mitesh, I think you're on mute. If you could unmute yourself, we could hear your call. Okay. All right. I think we'll get back to Mitesh in just a bit. For the time being, let's hop across to Nimesh. He goes through a whole host of brokerage reports. Nimesh, tell us, what's the standard brokerage report of the day?
Thanks, Nigel. So today's standard is on Bharti Airtel. A big downgrade coming in from JP Morgan. They've downgraded the stock now to underweight from overweight, and they've sharply cut the target price to 710 versus 860 earlier. So it's kind of an anti-consensus view on Bharti Airtel from JP Morgan. Now, why downgrade? There are 3 specific reasons for that. 1, higher than expected capex. 2, delayed price repair. And 3, lack of 5G monetization. These are the 3 reasons why they've downgraded the stock. Now, JP Morgan believes that Jio's shift to focus on higher-end consumers will mean that Bharti has to do higher capex and to defend the market share. And the competitive pricing in 5G would mean there will be lower free cash flow and return on invested capital. So these are the key reasons why they have downgraded. Now, JP Morgan says that the Bharti Airtel current stock price bakes in a modest capex in FY24, a 10% price hike, and continued return on invested capital expansion. All of 3 looks unlikely in the near term, and hence a big downgrade to underweight, and they've cut the target price now to 710 versus 860 earlier.
Okay, all right. Thanks a lot for that, Nimesh. Well, let's talk about JP Morgan's note on steel then. They believe there's more steel price hikes that are coming on board because Chinese export prices have moved to around $620 per ton. And in certain cases, it's moved even to around $635 per ton. The Chinese demand is expected to see a bit of an uptake post the Lunar New Year. So that's what will help pricing further. And domestic prices, they say, yes, it's gone up by around 1,500 rupees per ton. However, the landed cost of imported steel has come in at around 60,000 rupees per ton. And domestic prices are in the range of around 55 to 56,000 rupees odd. So they see scope for another 3,000 rupee price hike in the next 2 to around 3 months. They also take on board that, yes, coking coal costs have gone up, which will limit the margin gains. But overall, they're expecting strong earnings environment for Indian steel companies from here on. So expecting these stocks to do well.
Okay, all right. There's 2 minutes to go for market opening. So I'll use 1 minute out of the 2 to quickly put out some data. Right, we've been wondering, and this is nothing new, but just corroborating what's happening in prices with flows. We've been kind of, for example, yesterday we called it a puzzling fall because the globe was okay. Perhaps you got to kind of look at some high level reasons to explain this underperformance, and this is just zooming out and looking at returns, right? This is year to date, just the first 10 days of 2023. And you look at the stark underperformance of India. This is in dollar terms, by the way. India is down 1%, Nifty that is. Look at the other markets, China, Kospi, Taiwan, etc. Now, the flows, again, same markets, same period. This is YTD. The next graphic will come up. And I think it very clearly explains that there is more competition for foreign flows, foreign dollars. India has seen outflows of $1.3 billion. This is all Bloomberg data. Taiwan is up. Taiwan has got $2.2 billion in inflow. South Korea, Thailand, even Vietnam is seen $100 million in terms of inflows. I think what this shows is a couple of things. I mean, this kind of clearly explains the underperformance we've seen. This is very short term. Just, as I said, the first 10 days, year to date, we're just beginning the year and things could change. But India massively outperformed it last year. China reopening is a big trigger. We've heard that again and again from many people. China's weight in MSCI Emerging Market Index is now at 30%. The high was 42%, right? And India's weight is at a peak, almost 15% in the MSCI Emerging Market Index. India gets almost 94% of its foreign flows through these regional funds, not India dedicated funds. So this is important. So maybe a little bit of rebalancing as we've begun this year. But I can expand on this later. But I think we are at market open, guys.
You said you'll take 1 minute, but you took 2. I'm going to hold you on to that.
Clocking me, yes, Sonia?
Right. Well, the market opening is here and it's absolutely quiet. So I guess not much to talk about at the early moments of trade. Just that the mid-cap index is doing well, better than the frontliners, up over 100 points. And the Bank Nifty is also just a tad bit in the green. What's important to point out, though, is after yesterday's fall, there's no recovery on the headline index. So that's important. The Sensex is now down about 90 points. The Nifty is down 26 points. We were talking about how the texture of this market has weakened. It's now below the 100-day moving average. So just keep that on your radar. In that context, the start is not that great. Remember, we had positive cues to wake up to, but we haven't responded to that. That's an indication, perhaps, that this market is heading lower. Bharti Airtel is your big loser. There's a downgrade that has come in from JP Morgan, so that perhaps is one of the reasons as well. Down 3% and volumes are piling up there. HUL, Divi's Labs, Eicher Motors, Nestle. In fact, a lot of the consumption stocks, HUL, Nestle, Tata Consumer, are all under pressure right now. HDFC is also down about 0.3%, and now inching towards a 1% cut. ICICI Bank, Reliance and TCS are a couple of other stocks that are trending in the red. In fact, TCS post its numbers has not recovered at all. After the fall yesterday, there's still some more follow through on the downside today. So that just goes to show that this market is not prepared for any kind of disappointment in terms of earnings. On the upside, metals continue to rule the roost. So Hindalco, Tata Steel, JSW Steel, Nigel was telling us about a couple of updates there. So on trending higher now. HCL Tech is up about 0.4%. Adani Ports, NTPC, HDFC Life are a couple of other stocks. And SBI is also holding up in the market. Maruti is up 0.3% after unveiling that new electric vehicle concept. Of course, the car will be out in 2025. But nevertheless, the street likes the fact that there are new launches coming through from a lot of these auto companies. So in general, the market has opened with a downtick. And that's important because yesterday was a very weak day. There is follow through on the downside, and now the 100-day moving average has convincingly broken. Let's see. We haven't reacted to the positive cues, so that just goes to show that the texture of this market has been weak.
Well, that's right, Sonia. Yesterday's low was at around 17,850. I think risk reward could favor the bulls between the 17,800 to 17,850, given the fact that the PCR is at around 0.7. Let's see how that plays out. Few stocks that are doing well. Adani Wilmar is reacting to the operational update, so that's up close to around 2.5% as we speak. KRBL, well, the management sound very positive with regard to the revenue outlook as well as the market share gains. For starters, I think it was up by close to around 1%, so keep an eye out on that one. A couple of these sugar names are doing well. Sri Lanka Industries is up 2.5% odd. But the metals pack, well, you have Nalco that's up close to 1% odd yet again. Copper prices have been moving up, and there's only one direct play out there. That's Hindustan Copper. So that's opened up higher with a gain of around 1%. And JSPL sale, well, they are reacting to that note coming in from JP Morgan that they believe that there is still some upside with regard to steel prices, even post the 1,500 rupee price hike. At the low point of the day for the Nifty, with a cut of around 40 points, Nifty Bank is well down 100 points or thereabouts.
All right, so it's a slow start, but in the red, we'll see if things change and there is a more definitive kind of a move, because this is not definitive. It's neither here nor there. 17,878 is where we find ourselves at after yesterday's disappointing close. Another lower start. We'll see. Adani Wilmar is up 3%. It's the top volume traded name, 587 on Adani Wilmar. There is PTC, which is up 5% at about 96. BDL, that is Bharat Dynamics, is up 3%, 944. That is the defense play. Aavas, the microfinance company, is up 2%, 1864, 1865 on that one. Naveen Fluorine starts up 2%, above 4,000. The sugar names, Uttam Sugar, I can spot, but nothing more apart from that. RCF, a fertilizer name, 2%. Zomato starts about 1.5% higher. So these are a bunch of stocks which are starting up on volumes. On the downside, Bharti is down. Bharti is down on big volumes. And we'll have that up and look at the volumes on Bharti. It's down 3%, 768. And 2 million shares already traded on Bharti. So it's a decent cut, actually, for this time of the day, right out of the gates. Adani Enterprises was down sharply yesterday. It starts about 0.75% down. HDFC Limited is down 1% or so. Lever, HUL is down 0.75%, 2625. Schneider was up sharply yesterday. It's pulling back a little bit. It's giving back about 2%. And there is Info Edge, which is starting about 1.5% lower as well. 36.35 on Info Edge. Only highlighting, at least right now, things with volumes on them. The banks are all down, or not all, but at least I can spot IOB, Bank of India, IDBI, which are down 1.5% odd each. This is all the public sector banking space that I'm talking about. So the Nifty is down, 36 odd points. And I think we've got the Bank Nifty, which starts down about 1/3%. It's kind of doing a little worse off as compared to the Nifty. But as we've been saying, the Bank Nifty index broke and closed below last Friday's low. The Nifty did not do that. This is looking a little more trickier as compared to the Nifty itself. Ashwini Agrawal is our market master of the day, founder and partner at Demeter Advisors. Ashwini, welcome back. Great to have you with us here. Appreciate your time. I just put out some data, Ashwini, for year to date. The numbers speak for themselves. There has been about $1 billion of portfolio foreign outflows from India. And some of the regional markets have seen $2 billion, $1 billion, $500 million in inflows. This is a very short period, but a little bit of rebalancing happening. Ashwini, your sense?
Good morning, Prashant. Thanks for having me here. Yes, I agree with you. I think some amount of rebalancing is happening because India, in the regional context or in the emerging market context, I dare say even in the global context, has been very expensive for a while, and therefore some rebalancing appears to be taking place. But like you said, it's a very, very short period, just a few days of trading, and we have to see how this evolves. I think on the institutional flows part, I think 2023 will be a challenging year, both for domestic as well as for international flows, is my sense.
Okay, so 2023 is going to be a challenging year. I guess that's the narrative everyone's woken up to this year, right? That it's not going to be easy amidst the rate hikes and the inflation and the slowdown in growth. In that context, how important is the budget? Do you think there's anything that the finance minister can do? I mean, of course, it's a tightrope walk between sort of pleasing investors with some reforms in taxation, and on the flip side, sort of trying to, put in some growth parameters in place. But from an equity market standpoint, can the budget do anything?
So yeah, very difficult to say because the only thing that one can look forward to is simplification of the capital gains taxes, which has been spoken about in the press for a while. But whether that will mean good news for equities or not is very difficult to say at this point. Otherwise, I think just looking back at recent budgets, I think it's more a statement of India's finances, and that's how it should be, and probably an outline of the policy priorities of the government. And it's very difficult to expect the market to do anything on the back of the budget, would be my take.
Ashwini, morning. But what about the domestic flows? Now, over the last couple of years, that's what's been rock solid. The problem now is suddenly those yields are looking good on fixed assets, fixed investment assets, maybe some bit of a shift towards real estate as well. Do you think the domestic flows could be challenged and maybe finally retail starts booking out a little bit, or the inflows from retail slows down? Your sense on that?
Nigel, great question. And, I'd run through this arithmetic, a few months ago on CNBC itself. And the way I think about it is that, we have household savings of roughly about $700 billion, of which financial savings are about 350 billion. And if you look at long-term data, equity flows direct and indirect together. And in indirect, I include pension funds, I include NPS, I include life insurance policies, and so on and so forth, tends to swing between 10% to 20%. That is the estimate that I have seen based on various reports published by Reserve Bank of India and so on and so forth. So if you look at that number alone, the lower boundary is say $35 billion, which is not a small number. Even in the month of December, net inflows into equities, mutual funds alone was just shy of $1 billion. So, in the worst months, you will continue to see $1 billion, $1.5 billion inflow into equities altogether. And in good months, it could be a higher number. I think, obviously, the higher boundary of the equity inflows, which is say closer to 20%, will face a competition of sorts from fixed income because interest rates are now quite attractive. You're starting to see good corporate deposits at 9%, in some cases even 10%, and I think that's a pretty chunky return for most retail investors. It's a positive real return, and therefore bonds do merit a look. And I think that will reduce the amount of allocation towards equities in the coming year. But like I explained, I think the incremental savings and the incremental allocation will still be positive. And I don't think the allocation away from existing pool of assets will be large enough to turn the whole number into a negative. At least that's what the preliminary arithmetic looks to me right now. It could turn out to be different as the year progresses, because retail investors do get influenced a lot by trailing returns, and 5-year returns at this point in time from mutual funds are not looking, very enthusing, and that's a challenge, I think.
Okay. I wanted to draw your attention to the telecom space purely because the stock of the moment is Bharti Airtel on the downside, and I just want our viewers to take a look at that as well. Now, there was a JP Morgan downgrade that has come through this morning, and the premise of that downgrade is that the 5G rollouts, as they begin, are going to get very competitive, hence putting pressure on the operational performance. And there's also a big battle for premium smartphone subscribers, and Reliance RelJio is getting into that in a big way. Now, what happens here, Ashwini? Because, this is a space that has done well recently, and of course, the future is looking bright, but there's so much competition. If you are invested here, do you churn out or do you stick with these telecom names?
Surya, it's difficult to say how the competitive pressures shape up, but my preliminary sense would be that, it's pretty much a duopoly right now if you look at the sector. And the two players you spoke about, command a lion's share of the market. So it doesn't appear to me to be very logical to say that, there will be intense price competition between these two players for market share, which is harmful for both of them. So let's see how it evolves. I mean, historically, that what we've seen anywhere else in the world, and even in India, if you just think about what's happened over the last year, a year and a half, is that pricing competition tends to be a little reduced when you have just 2 players or 3 players competing for market share. So I don't share the concern on pricing pressure right now. But I haven't seen the report that you spoke about, and I haven't seen the arguments they've made, so I can't really comment on it. Logically, it doesn't seem so concerning to me at this moment.
All right. Look at the market, though. We are down, 70 points, and it's a real risk that the December low of 17,774 comes into play at some point. I mean, the way it is going. So we're around 67, 68 points, a third of a percent lower, and just about 65, 70 points away from that particular level. And in a way, it's too early to kind of say it conclusively. It's something similar to what we saw yesterday, although today it's more mixed, right? I mean, you've got the Indonesian market, which is down 3/4. Kospi is higher. Taiwan is absolutely flat. Hang Seng is up a little bit. You don't have anything... any reversal in the US futures. So, but there is a little bit of that tinge of underperformance. And I think that stands out and pinches a little bit more because usually we're all used to, with the recency bias, standing out in a positive way, and not on the other side. As I explained on Market Laser, this looks like, a little bit of reallocation away from, what has been a hugely outperforming market the last year. To some of the other markets. In the longer run, of course, I mean, this is very short-term phenomenon. Of course, in the slightly medium to longer run, fundamentals, growth prospects, etc., will matter a lot more. But for now, there is, I guess, a little bit of tactical adjustment, which is taking place. 17,846 or so is where we're at. Ashwini, apart from fixed income and bonds, which you clearly like, coming back to equities, what would your top ideas be?
Prashant, I've been very positive on the banking space. I continue to be positive. I think there is some fear of NIM compression as cost of fund increases. But my sense is that on the credit cost side, we are going to see positive surprises. So I still see earnings from the banking sector to be quite robust. I also like a lot of the small and mid caps at this point. Because I think 5-6% real GDP growth over the next 12 to 15 months is going to come through despite all the challenges, and with a lot of the cost pressures easing both on input materials as well as energy. My sense is that margins will normalize for a lot of players, and I think this is where there might be opportunity to make money from a bottom-up basis. I also think that as tech stocks take another breather post the December quarter numbers, they might start to look interesting once again, given the dividend yield support they offer, and valuations might again start looking reasonable in a quarter or two. So those would be the few areas that I would point to. But I think it's going to be a more bottom-up market, and it's not going to be very, very sector-specific per se. That's the sense I get at this point.
Okay. Just before we let you go, do you like any of these life insurance or these insurance players? Because we're heading into a discussion next. So just wanted your thoughts as a premise to the conversation.
Yes, I do, Sonia. They've underperformed quite a bit over the last 2 years almost, and valuations are now reasonable. Most of the insurance companies are between 2 to 3 times embedded value. And if you look at the long-term growth prospects, they are also pretty solid. And I would say the same for some of the standalone health insurance companies where valuations are starting to look quite reasonable. And these are very, very solid, well-run, long-term growth businesses. So yeah, they do look interesting to me.
Okay, well, on that premise, actually, we'll take your leave. Thanks a lot, Ashwini, for joining in. Always great speaking to you. So much to learn, and hopefully, we will chat again very soon. That is the word coming in on the markets and on the insurance sector. So let's take it straight to industry leader Life Insurance Corporation of India, or LIC. They reported a total APE growth, an annual premiumized equivalent growth of 5% and total premium growth of just 4% versus last year. Now, to discuss the outlook for the business and the divestment plan with respect to IDBI Bank, also on ITC, we're joined by Raj Kumar, the Managing Director at LIC India. Mr. Kumar, thanks a lot for joining us. First I wanted an outlook on what the premium growth would look like by the end of this year and next year, because I think that in the new business premium, your year-to-date growth has been about 40% year-on-year. What's the outlook now?
And good morning. Thank you for giving this opportunity. You see, we have to look at different perspectives when we are talking about the life insurance industry. In fact, post-COVID, there have been a number of factors which are actually impacting the life insurance sector at all. The one is that the risk perception has gone down after the moderation of the COVID impact. Then the second factor is the revenge spending which is happening in the market, which is reflected in the GST collection and the direct tax collection, which is at a very high rate. And the third part is that the life insurance, the rising interest rates. So we are also competing with the household segments. Giving all these factors, and also the most important thing that it being a push product rather than a pull product, life insurance industry as a whole and corporation as a whole has done very well. As you rightly said, we are growing at around 40%. And we believe that the event spending and other things are also moderating. And the same kind of outlook we are looking for the fourth quarter also. And next year, yes, it will be again a challenge for the industry, because for us also, because the base is getting bigger and bigger, and giving a growth over that itself becomes a challenge. But we have our strategies in place, and we believe that we will be able to sustain a high rate of growth in the future also.
So when you say high rate of growth, what is the kind of growth you're looking at? Are you looking at high teens? In FY24, what is the kind of growth that you're penciling in?
You see, the one is that it's very difficult to give a forward-looking statement. But the overall business strategy looks into the kind of opportunities which are available in the market. We have been very strong in the non-par side, but there was a time that when, 20, 25 years back, when we were very strong in the non-par business. The thing was that as per the LIC Act provisions, Section 24, we have to have a single fund only. So there was no classification of par and non-par. Since last year, the act was amended and we also bifurcated the fund. So now we are looking at the growth opportunity in the both sides of the business, not diluting our focus on the current strength, but we are looking at the opportunities which are there in the non-par side. So that looking into that, we believe that there is a great opportunity for us to grow at a very higher rate. It's very difficult to predict what kind of percentage terms it will happen. But yes, the opportunities are there.
Okay, all right, Mr. Rajkumar, but give us a couple of numbers. You're saying the non-par segment could see some bit of traction. What is the growth you're looking at in that segment, first of all? And also, if you could tell us, the embedded value. I think you had indicated that it's likely to see an increase in FY23. By how much? What could that number be?
No. You see, first of all, it's a silent period. Q3 results are still not out. I will not.
Sir, we don't want to know about quarter 3, sir. Let us talk about the way ahead. FY23, FY24.
Is a far ahead, but let me tell you. Last year, when we bifurcated the fund and the non-par business was say 5.9% in the APE. Now, presently, it is 9% as we close Q2. We are witnessing a higher growth in the non-par segment, so it is going to add to the APE as well as in the BNB margins. Now, coming to the embedded value is a factor of the kind of business we underwrite and many other things. And it also takes into account the market value of the investments, in particular in the equity side. So it also depends upon how the markets are behaving. Unfortunately, in the first quarter, the markets were down, and at the end of the second quarter, that in 30th September also, they were again down from their peak. So it impacts. The EV is calculated on a given date, but if you ask me, EV changes every day. If the markets are going up, the EV will go up. If the markets are coming down, the EV will come down. But we are looking at that there has to be a growth, 5 to 6% growth we are looking at having a very large base of 5.44 trillion of EV, which was as on 30th September.
Right. And that sensitivity to market remains very, very high, right, Mr. Kumar?
Yes.
Good morning. Prashant here.
You see, Prashantji, the thing is that in life insurance, the majority of the investments happen in the debt side, because there are contractual liabilities which are to be repaid. But we do invest in the equities also, and yes, say 18% almost we have invested in the equities of our total AUM on book value basis. So that also, there is a huge MTM gains in that. So the market volatility in fact impacts the MTM gains there itself, which we have disclosed in the RSP also, and after the Q2 results also. The 10% market going up or down, it impacts the EV by 6.5%. So there is a sensitivity.
Okay, 10% move in the index, I guess, 6.5% impact
Yes.
on the EV. All right, Mr. Kumar, 10%.
Sorry.
Yes.
1% movement up or down in the indexes, it impacts us by 6.5%. The financials.
Yes. Now, just to come back to those numbers, towards the end of the last answer, you said we expect 5 to 6% growth. This is
that I talked about the EV, embedded value.
Okay. On retail AP growth, I mean, if you can give us some indication of what your targets are for FY24, because that has come off. I mean, even year to date for the 9-month period as compared to where you were 1 month back. I mean, there is a slowing down which has happened. If you can provide us with some indication, broadly, how are you thinking about retail AP growth in 24? Go on.
AP actually is the kind of business which underwrite. For example, in case of the non-par business, the AP factor will be higher, and then again in the single and non-single, there are different multiples which are there. So presently, as I said, in the non-par side, we were at Q2 at 9%, which was 5.9% as on 31st March. So we are focusing on the non-par business to increase the AP size also. And we will be looking at that, what we have predicted and what we have discussed in the RSP while going for the IPO. We are on the track. We have given a kind of 5-year scenario for us to bring a total change in our business mix. Because I cannot simply bring a disruption which can cause my strength presently into a weakness. So we will be looking at that maybe 8 to 10% kind of growth in the AP in the final ending. We are looking at that.
Okay. So I wanted to ask you, there was a comment from the divestment secretary where he mentioned that the government and LIC are looking to sort of pair their stake in IDBI Bank. The last time we chatted with you, you said you're keen to continue the partnership there. Just wanted to understand how this is going to play out. Are you planning to pair stake or exit IDBI Bank in the due course of time? And in this calendar year, anything that's planned?
No, when we invested in the IDBI Bank, we sought permission from the IRD as well as from the RBI, and they had given us some timeline to bring down our holdings in IDBI Bank. Now, let me also discuss here that LIC Act 1956, a notification was issued by the Government of India in 1958, which allows LIC to have up to 30% in any organization. Although the RBI and IRDA dispensation tells us to bring down below 20%. So we are committed to that because we can't put a large risk in one particular company. That was a strategic investment, and we will continue to be in the IDBI Bank, but not at the level which we are at present, that is 49.64%.
So you'll be bringing down your stake, Mr. Kumar. Will you be bringing down your stake from this 49% odd? And
yes.
Okay.
We are
to what level, sir?
It will be less than 20% after the 20% presently, with what the RP which has been floated by DIPAM itself has mentioned that how much stake LIC and Government of India is going to divest. After that number, which is more than 30%, we will be still left with around 19%.
Okay, so you're committed to bring down the stake below 20%. What is the timeline again? By when do you plan to do it?
No. This will be happening with this, strategic sale of IDBI Bank, which Deepam has already started.
Okay.
Got it.
Okay.
All right. Got it. So what about the stake that you have in ITC? Plans on holding it on, or I think you have close to around 15% stake out there as well.
No, we have many other companies which we are having very high stakes. Why to talk about ITC only? I mean, as I said, that LIC Act allows us to go up to 30% in a company. So it is around 60%. So we have still a margin of 14%. But yes, it's not that we will be taking.
Oh, I can't hear you. So I think there's some issue with the audio. We'll just come back to you in a bit.
Risk in one particular company only.
Yes, go ahead. Sorry, we actually missed that. Can you just repeat what you were saying? Yeah.
I will repeat. I was saying that there are many other companies which were having more than 10%, even 13% also. So that's why we still have to single out ITC only. The LIC Act itself allows us to go up to 30% in any company in equity investment. So what we cannot take a very huge risk in a single company. So it's a strategic kind of thinking and investment strategy is there to keep invested or book profits. It's a regular exercise for us. It's not that we keep invested. We have gone on record many times that we are very contrarian in our investment approach. We do book profits and we do re-enter into the same market to buy the same stock. So it's a continuous process for us.
Okay, sorry, I just come back to IDBI Bank because I just wanted clarity. I didn't get the exact timeline, but you said the process has begun for paring down your stake to below 20%. But by when do you think this will get concluded?
No. You see, ma'am, this Reenaji, this is spearheaded by the DIPAM, Department of Investment and Public Asset Management. The government of India is going to bring down its holding in the IDBI Bank, along with the LIC will also be doing the same at the same time. So whenever this strategic sale happens in IDBI, Government of India as well as LIC will participate together.
All right. Okay, we will leave it at that. Thanks a lot, sir, for joining in and giving us an update on the business as well as the strategic stake sales over there. So that's LIC. But let's move on. Let's focus on the Reliance Capital IBC case. Sources tell us that the Committee of Creditors has voted in favor of conducting a second round of auction. Ritu Singh is here with details. Ritu, over to you.
That's right, Sonia. Reliance Capital is going to go under the hammer again, with 98% of the lenders approving a second round of e-auction for the company. This time around, we're given to understand that all 4 bidders will be allowed to participate, which includes Torrent, Hinduja, Oaktree, as well as a consortium of Piramal and Cosmea. The second round of e-auction is likely to be conducted on the 19th of January, a few days after the NCLT is expected to hear a crucial matter in this case, where one of the bidders, which is Torrent, had objected to the second round of auction being conducted and to any revision in bids from the players. So that hearing is going to be critical to watch out for. As we've been reporting, the base bid is going to be set higher at 9,500 crores in net present value terms, with a minimum 8,000 crores in cash component. In the first round, if you recall, Torrent had emerged as the highest bidder with 8,640 crores as its offer, but Hinduja had subsequently revised its offer to about 9,000 crores, which Torrent had protested and got an interim relief from NCLT, which had asked lenders to not consider the offer until the final orders were given, which are still awaited. And subsequently, Torrent had also tweaked its offer to the entire sum as upfront cash. It has protested that allowing the challenger process to be reopened is in violation of the process and of the rules and spirit of IBC. So we'll have to see how this proceeds, and important will be to see what NCLT has to say in the matter, whether it allows the process to go forward.
All right, Ritu, thank you very much for that. So that is Reliance Capital in focus. The market, by the way, has cut its losses in half. We were down 70 points. We're down about 35 now, 17,880 or so. Look at that graph there. Sharp bounce and now another kind of sell-off, which we've already seen. So volatile out there. But let's hope things stay above that weekly swing low of 17,774, and we don't see another shakeout like what we had yesterday. We'll take a quick break here. Another management joins us on the other side. We have PSP Projects, which will join us to talk about their 2023 outlook and strong order inflow, which they've seen. Later, we'll analyze expectations from the auto sector in the third quarter in our special segment, Quarter Se Quarter Tak, and of course, discuss more with Vasudev Banerjee of ICICI Securities, who tracks that space. Stay tuned. All of that coming up after the break.
Co-presented by Bank of